Welcome everyone to Advanced Cost Tracking in OpenAir. My name is Ron Bro from TopStep, and appreciate everyone's participation today. We're going to cover some overall information on how OpenAir deals with costs, and so in the next hour. So what we're going to cover today is what types of costs are we tracking, or is OpenAir able to track? How those cost centers work and how those factors in. We'll get into some specific costs, cost options, user costs, labor costs, how to approach it, expenses, purchases. We'll talk about some reporting information, and then we'll finish up with our summary of data we found. Okay. Okay, so why do we track costs in OpenAir? Well, most organizations use OpenAir for cost tracking in order to get project margin or profitability. Since most ERPs do not track dollars and costs down to the project, then the only option for a lot of organizations is to use OpenAir to do project profitability. In order to have project profitability, you really have to track three different types of costs. Some of these may not be appropriate to your business, but the three costs are labor. How much time is your employees spending on the project, and what is the cost of that time? Expenses, how much travel is being incurred, and the cost of that travel. And any non-labor, non-travel expenses. So if you are doing any other types of product or services that you need to track costs against, then you also have those purchasing costs associated with the project. So we'll talk about each of these in detail in the next few slides. So costs are generally associated to a object. So users have costs, and expense reports have costs, and products and purchases have costs. You can also track costs via a cost center. So we're going to talk about cost center and how those can be used in OpenAir. So cost centers, what are cost centers, and why would I use a cost center? Well, cost centers basically allow you to stamp transactions with regards to costs and be able to then run reports. So who can belong to a cost center? Well, a user can belong to a cost center. Clients can belong, projects. You can add cost center to all the objects in this slide: task, expense items, time types, and services. And the idea here is you can belong to one cost center at a user level, and then work with clients or projects that belong to a different cost center. And then you can do cost tracking and potentially cross-charging. So we'll talk about that. When you are setting up cost centers and you want to use cost centers for tracking costs across objects, you will want to make sure your cost center is enabled to be able to add to time entries and expense rules. So within time entries and expense rules, you can determine where is the cost center going to live. So if you, for example, wanted to have it at a user level, then you would have a user selection, and at a project level, you would have project selection. So you can choose where the cost center appears. Once you do select where the cost center appears, then you have to determine what is the order in which the system will assign a cost center to the cost. For example, if you select project, then user in the selected side of the screenshot, then when you put your time against your project, the cost center assignment will look at the project first. If there's a cost center there, it'll stamp the time entry. If there's not, then it'll go to the user's cost center and it'll stamp. So the order in which you select your items and how you organize those is really important to determine where does the cost actually get associated to, what cost center does it get associated to. and you can have the same order for both time entries and expenses, or you can have different. One of the things that we find with a lot of clients is they don't realize that cost centers are sticky values, and when you're entering transactions, so I'm entering time or I'm entering expenses, and those transactions get stamped with a cost center, if you change the cost center after the fact because it was either set up incorrectly, those transactions are still with the original cost center. So those cost center stamps do not get changed unless you were to go in and do some sort of a database update, or you would to do some sort of a reversing entry via a timesheet or an expense report to reverse the cost center value. But it's important to know that those are stamped, and those will follow the time entry throughout the process. Also, it's important to know that there's no timing. The timing of updating cost centers is important. So if you are going to change cost centers, a user moves from one cost center to another, you have to be very careful to know when is that effective and how to apply that change, because there's no real date effective way to say I'm in this cost center today, but tomorrow I'm in another cost center, because of the way that OpenAir designed the cost center functionality. So you really have to be careful when you make that change to know that all time entries have been entered that were entered against an old cost center, and now we want to add a new cost center for future use and understand that what that means. There is ways to track movement from cost centers. A lot of customers may be using what OpenAir calls user entity tags. So user entity tags are really just custom fields that give you the ability to add date parameters to the custom field. So you can say I'm in this cost center, but between these dates I was in a different cost center. And I would recommend using this in addition to the standard cost center if you're looking to track movement across cost centers. If you're doing any kind of reporting of dollars or time by cost center, and you want to be able to show that the person was in one cost center and then moved to another, entity tags can be an appropriate way to basically do that. But again, this is not replacing the standard cost center functionality that OpenAir gives. It's more enhancing the reportability of cost centers that when folks move from one to another. So the pros of the user entity tags is the date effective control. And you can use these entity tags for all types of tracking, not just department or cost center transfers. Obviously, the cons is there's no inheritance. Right? These are not sticky values like cost centers are. So they really are just for supporting reporting that we talked about. And you can only have these on users. So if a project changes cost centers, that's not something you can use these entity tags for. At this point, OpenAir only opens these up for users. And of course, these are not sticky values, as we talked about. So this could be an enhancement to your reporting capabilities, but definitely not a replacement. So cost center is a way to track user costs and stamp those user costs. So let's talk about user costs in theory. So on a user's record, you have the ability to track a user's cost. And every customer that has the desire to do project profitability has to figure out a way to put costs in the system that they're comfortable doing. And that's always a conversation we have with clients is, I want profitability, but I don't want to put in costs because we're very sensitive to that being in the system. So you have to really understand what your strategy is for putting costs in the system, how accurate do you want your reporting to be, and understanding what are the security options you have for limiting access to this cost data. So in addition to tracking a cost, you can actually track cost changes. So for example, if one cost option change is if someone gets a raise year over year, then you could track that change in their cost for those years. And when you run reporting, it's important to know what value to choose so that you get the date changed cost versus the top line cost, and we'll talk about which values you should pick as well. You can control who can get to what costs based on the OpenAir role. So on the role, it says you have access to the primary or the secondary or the tertiary, depending on how many costs you have in your environment. You can control who can see those costs and run reports on those using those costs. So as I mentioned, there are 3 different costs available for a user. You may want to ask, why would anyone need 3 different costs? Well, there's a lot of business requirements we run into that determine how many costs an organization needs to implement. So what I see often is a primary cost, which would be the first cost, is really used to track really salary level hourly costs for an employee. So some calculation using salary and benefits and anything else that the organization feels they need to. And they enter a primary cost using that on a per person basis. Well, obviously this is can be very make HR people skittish and also want to protect that cost and only maybe allow certain levels of the organization to actually run reports and see that cost. And you can do that, as we mentioned, in the role. So you can have executives be able to run reports with this cost in it, but other folks in the organization you could limit, they can't run this cost. Well, if you have project managers, for example, and you want them to have access to some level of project profitability, but you don't want them to see the person's hourly cost, then you may have a secondary cost that you use that's more of a blended rate. So you could say all of our developers are X amount of dollars per hour, and all of our project managers are a different value per hour. So you do a blended rate across your different groups, and you can then you allow other parts of the organization to use those costs in reporting. And that way they can get still some profitability reporting. It won't be as accurate as using the primary cost, but it'll be close enough to where they get a feel for how their projects are running and giving them the information that they need to do their job. So you'll notice average cost in here is a terminology override. So multiple times these costs come out as primary, secondary, and tertiary, and most organizations will do some sort of an override to make it more useful and descriptive of what the cost really is. You can also see that one of the costs here is used as target bill rate. We're going to talk about that in a minute, but that's another business case for having multiple costs. Is I want to be able to say, what does this person generally bill at, and then be able to do calculations that take their hours and that secondary or tertiary cost, and that says, well, here's what this person should have billed at versus what they actually billed at, and be able to determine what the delta is, or realization reports. So again, another very common business reason for implementing multiple costs and using one of them as target bill rate. So I think I've already talked to this screen, but again, we talked about the difference between you may want to have a salary versus a blended, target bill rates that you can use for bookings or forecasting, as well as doing rear-end reporting on actuals versus potential. Also, another common that we've seen over the years is for revenue recognition, there is a revenue rule that does percent complete, but the percent complete is based on cost, and that's the incurred versus forecast rule. So if you're using the incurred versus forecast rule, or you want to, the benefit of the incurred versus forecast rule, it has more flexibility than your standard percent complete revenue rule, as it lets you use you can use assignments as your basis, which is what the percent complete rule does, but this also allows you to use bookings as the basis instead of assignments. And a lot of organizations I've worked with recently, they're really using bookings, resource scheduling to really drive their forecast, but they also want to do percent complete based on that same value. So if you're going to do that, the incurred versus forecast rule really is the rule you need to use to do that. However, when you factor in costs in this rule, it can get quite complicated, and auditing the data could be very, very restrictive. So what a lot of organizations say is, let's put a cost of $1 on all our employees, on all our users, and so when they enter hours, the curve versus forecast rule ends up being an hour-over-hour calculation. And then it becomes much easier to audit, to back into your numbers as needed, and it behaves, again, like the standard percent complete revenue recognition rule, except for the fact that on the denominator of the calculation, it can use bookings. So we've seen a lot of organizations move to this type of revenue recognition, and having this standard value of $1 is very beneficial for that. So adjusting costs and cost overrides. So all hours recording the system have the same cost. So as you're entering time, your cost is applied. Profitability will be looking at hours at the cost rate. Where I see another, again, very common business case is that our folks may work overtime, but we don't. If we come up with an hourly rate, it's based on a 40-hour week, and we don't pay them anymore when they work 50 hours or 60 hours in the same week. So in that case, what's happening in our margin reports is that the margin's being understated in our reporting, because it's taking the 50 hours and it's multiplying it times the cost rate, and it's getting more margin than what it should be. And so we find this is very common with a lot of PS organizations, where they want to be able to adjust that hourly rate based on the number of hours worked. So there's a way to do that. And it's a pretty interesting way that OpenAir designed this. It's been in the system for quite a while now. In the advanced reports section that that is not very common to use anymore, there is a historical utilization report. And this report you can use to flatten the costs based on the utilization reporting. So if you run a utilization report, you can then use that report to be able to adjust the cost for that period, to be able to say, to be able to lower the hourly rate so that the 40-hour cost is the equivalent of whether they worked 40 or 50 hours. So in this, in the advanced report, this percent utilization is the report that you can use to do this. And then, as I mentioned, when you're configuring the report, it's important that you pick a time frame. Most organizations I've worked with look at this on a monthly basis. So at the end of the month, after all time has been entered, they'll generate a report of this historical utilization. Now, you may do it based on just billable hours, or you may base it on all hours. It's really up to the organization how they want to do the adjustment. But you'd run the report, and then you would then, from the output of the report, you can determine, you may want to then adjust those costs. So if a person didn't work enough hours to get to 100% utilization, maybe you want to increase their hourly rate for that period. If a person worked more than the par hours for the month, then you may want to decrease their hourly rate in order to not overstate your costs in reporting. So again, a lot of ways to do this, and can be very beneficial for getting those margin reports much more accurate. Again, so here's what the report looks like, and you'll notice at the bottom of the report there is this, if you have this enabled and you have the right permissions, there's a click here to adjust for the loaded costs after you run the report. Again, if you don't want to adjust everyone in the report, what mostly we'll do is run the report, figure out who needs to be adjusted, remove everyone else, rerun the report, and then use the adjust users loaded costs option here by clicking. When you do that, it opens up a new window that says go ahead and run cost adjustments. And if you're redoing a month that you already did, but you had some additional time, so you want to redo it, you can also override whatever existing costs, so that you could go ahead and redo the cost adjustment. Best practice that we've seen with organizations, the primary cost, when you're doing that adjustment that we just walked through using the report, the only cost that can be adjusted is the primary cost. So you do not have the same capabilities for if you have a secondary or even tertiary cost. So you have to think about, if you're going to do this type of adjustment, then you have to think about how that primary cost is the one that's going to get adjusted, and so that may dictate how you determine how to calculate the primary costs. Again, you can do this for a single or minimal number of folks by running a report and then removing those from the report that you don't want to get adjusted. Most people do not adjust their hourly rate up, so they would remove anyone that didn't meet the criteria so that they go ahead and just adjust those that need to be adjusted down. And again, monthly is what I've seen most common. You could do it weekly if that was something that needed to be done. And you also need to determine how do you want to, what's the percent utilization that you want to calculate. So again, just always, utilization reporting per company is always different. So just determine what that looks like. And again, if you're adjusting people less than 100% increased costs, if they're more than 100%, then you lower their cost by using this trick. Let's talk about other ways to do cost overrides. What we see here is the most common way I see this is where maybe you hire a contractor who, quote, gives you an hourly rate, and then on one project his hourly rate is X, and on a different project maybe he's doing a different role and he has a different hourly rate that you negotiated. And so you want to be able to override their costs at a project level or even at a task level potentially. Not as common, but certainly it is doable. So you can actually override costs at a project or at a task. These are internal settings you have to ask for support to enable. But at the project level, I see most common is where you can say, this person's override for this project. And that, again, with the goal of getting profitability as accurate as possible at a project level. And you can adjust all the levels of costs. Again, if you have multiple costs, you could adjust primary, secondary, or tertiary costs. Again, why would I use this? You could have a transfer cost you may want to use, and you may want to have that set at a project level potentially. We talked about subcontractor variable rate. Or you may have target bill rates that are per project. So again, you may want to say that our target bill rate on this project is X if you need to do something like that. I mentioned earlier in reporting on costs where you have the different, we have multiple levels of costs, right? So you have the cost that is at the top level, and then if you're doing any kind of adjustments either through the utilization report or if you're doing any kind of year-over-year adjustments because people get raises, you want to make sure, depending on which costs you're trying to use in reporting, that you choose the right costs. So in OpenAir, when you go and look at timesheet cost values and summary reporting, you'll have a couple. You'll have based on one that says actual costs and one that says current costs. So actual costs is actually the one that is time stamped if one exists. So if I had a cost for last year and then a new cost for this year, and I ran a report for last year and I want to use the last year costs, I would want to make sure that I pick the actual costs versus the current cost, which is actually the top level number that the costs are derived from. So that would be my top level hourly rate, which would not change based on the dates in my report. So just depending on what you're trying to report on, you make sure that you choose the right reporting fields in your report. So let's talk about expenses. So everyone who uses OpenAir for expenses knows that you can use these expenses to generate travel associated to projects. And again, this becomes immediately reportable as soon as the expense report is created. It doesn't have to be approved to be able to report on it. You can actually report on open or unapproved expenses as well. You can also do, within receipts, generally you can do receipt to a project, but you could also go down to a task level if you wanted any more detailed reporting. So if you wanted to see, how much this task costs, you could certainly go down to that level in receipts. Most companies do not do that. And there's been a lot of improvements and a lot of new functionality around expense reports as well that have come out. A lot of organizations have per diem. Either they bill per diem, they pay per diem, or they do both. So you can handle per diem on expense reports. If you pay actuals but you bill per diem, certainly you could have actuals being entered and then have your billing rules set up to bill your per diem amounts, and that gets you your cost of actuals. If you're paying per diem as well as you're billing per diem, then you can certainly have folks entering those per diem amounts in their expense report and then billing those back to your customer. Purchases. So purchasing module in OpenAir has been around a while. Most organizations that use this, because they have non-labor costs and non-travel costs that they need to track against a project, and the purchases module gives you the ability to do that. Now there are two primary ways you can enter costs into the purchasing module. One is called a quick PO. What a quick PO does is it basically says, for this project I bought this product for this amount of money and on this date. And once you save that value, it immediately becomes a cost against the project. Quick POs are very popular because they're very easy to create, and they are very simple to report against because they immediately are cost against your project. I see quick POs used a lot for if you're going to be loading data into OpenAir or you're transferring cost data out of your ERP into your OpenAir system. Quick POs would probably be the most efficient way to do that, to create those in bulk. But it's not the only way. The other option for purchases is a full-blown purchase process, which starts with a purchase request. So for other organizations, the project manager or someone on the project team may request that a purchase be created. That purchase request can then follow an approval process that could end with the accounting folks. They would then convert that purchase request to a purchase order. Purchase order can also then be approved. Again, not required, but can. And then once that purchase order is approved, and then you receive the amounts of the products identified in that purchase order, then you would go in and you fulfill the purchase order by saying, we received this quantity of these items. And only for fully fulfilled purchase order then hits your project from a profitability. So when you're reporting on purchases in the OpenAir system, it only really shows you fulfilled purchases. Quick POs are considered fulfilled by the nature of how they're created. So that's why they become immediately available, versus purchase orders have to go through the fulfillment process in order to actually become fulfilled, and then that hits your reporting. So again, quick POs quickly capture the cost of a product. It becomes real time, and it doesn't require and it's not available to do any kind of review approval. So it's just someone entering costs. I see this, like, for example, a company might have legal fees that they want to be able to enter real quickly into OpenAir so that their project profitability is adjusted based on the legal fees associated with the project. Purchase orders, again, start with a request, and these requests, are both quick POs and POs, full POs, are associated to a vendor. So you have to have, there's a lot of setup to use this. You have to have vendors and all kinds of receiving locations and approved purchasers, et cetera, that you would set up in advance. And again, the cost does not get applied till it's been fully fulfilled, and then you can have cost in your project. So again, reporting obviously is going to be the recipient of all this good information that we've just covered with regards to managing costs. So you can control what costs are reportable at the role level. So you can limit, we talked about limiting which cost levels are available to certain roles in the organization. You want to make sure you're doing actual costs versus current costs to make sure that you're getting those adjustments that you're making either year over year or time period over time period based on the overtime adjustment you want to make. And you want to make sure that if your purchases are coming through and once they're fulfilled, they'll be included in your report. And again, only fully fulfilled POs will show up in the costing. You want to make sure that your expenses are hitting your project accordingly, and making sure when project expense reports have lots of different dates, right? There's the expense report date, there's the date it was approved, there's the date it was submitted, there's the date it was created, there's the receipt dates. So making sure that if you're doing monthly cost analysis, making sure that you're setting your reports to pick the date on the expense report that makes the most sense for your reporting to make sure that you get those costs in the right time period. So we'll go ahead and summarize this. I'm going to then unmute and we'll open up for questions. Again, the idea of cost tracking is really to be able to track and transfer costs, to compute revenue targets at a person level, profitability on projects. So all of these are real, if these are goals of your organization within OpenAir, then cost tracking is how you would accomplish those things. And it's just not timesheets. It's really more the timesheets, expenses, and all the other items that may be associated to delivering a project. And again, if you're not using any of this cost tracking that we talked about today, it's important to really understand your policy, especially with regards to user costs and really procedures that you have today, and really how do you implement this in a way that fits your organization the best way. And that's really where you would want to start. And that's where the conversation starts with us when we meet with our clients. So we're ahead of schedule today. Hopefully I didn't go too fast, but I'm going to go ahead and unmute everyone.